Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday? Welcome, everybody. So this presentation is going to be talking about a unique concept that that we've all used in our lives, and I'll share a bit about my story here in a moment. But I want to ask everybody here a question, and that question is this: what in life should you control? Now, there's lots of things that we should control, but there's three main things that people think about when they see this question. But use that chat box. What are some things in life that you believe that we should control or want to control? Now, I know some of you have seen the presentations, you know exactly what these are. So the first one that a lot of people say when they hear this question is money. We should control money. But unfortunately, we don't. A lot of us don't. We actually give control of money away through debt, mortgages, 401ks. We give control of that away. Or if you have an employer, like I used to have, they controlled my income. The second thing that a lot of people say, which obviously Henrietta and Marco said that as well, is time. Time is that one resource that once it goes away, it never comes back. Now, for me personally, time is my biggest thing that I want to control. Money, yes, but I prefer time. But if you look at time and money, which one do you got to control first to control the other one? Well, it's money, right? You can't really control time if you're not controlling money first. So typically, it's control money and then you can control time. But there is a one thing that I believe above all else that you should understand and control. Now, that last thing is your mindset or knowledge. Because as we go through life, we're taught certain things around money or time or life or beliefs that are not our own. We're programmed to believe certain things. And so you've got to understand that, like, when you go through this presentation, I'm going to be challenging the way you think about money as an example. And that's all about mindset. But if you don't control your mindset, by the way, somebody else will. All right, now I want to share this quick quote by Will Rogers that we here at the Money School really like. And that quote is this. It says, "The problem in America isn't so much what people don't know, it's what people think they know that just ain't so." So once again, as I said, we're going to be challenging the way we think about money during this presentation. Now, I also want you to envision this. So I want you to think about this. Let's say you put 100 18-year-old kids into a room and you ask every single one of them, where will they be at the age of retirement? Now, what are they going to say? Are they going to say, I'm going to be broke and poor? No, they're not. They're going to say, I'm going to be successful. I'm going to have my dream job. I'm going to be wealthy, rich, a millionaire, etc. But here's the real truth. At the age of retirement, let's say age 65, 5% or 5 out of those 100 18-year-old kids will be financially secure. Not free, by the way, just secure. So that's the real truth right there. And so in the land of America, or North America, the land of of opportunity, why is it that only 5% of those 100 kids are going to be financially secure? The other 95% are going to be broke, poor, or struggling financially at the age of retirement. Now, that stat does not just something I pulled out of thin air. It actually comes from the Social Security Administration. That's who says that. So let me ask you all a question here. Who here wants to be one of the 5% and not the 95? Give me a 1 or a yes in the chat box if you want to be one of the 5, because this strategy we're going to be talking about here today can help you and help your kids, your family be part of the 5%. Make sense? So a little bit about me. So if you guys have not seen me before or heard me speak before, so my name is Brian Fouts. I follow that traditional path through life. That's my degree, construction management and business from Washington State University. I don't know where it's at. I have not used it in many years, to be honest. But I did that career for a long time. And that's what I call the hard way. And so I was raised lower income, my great family still together, all that kind of stuff. But we didn't really have a lot of money growing up. I was never taught about money growing up either. I was told, go to school, get a good job, all that kind of stuff. And that's exactly what I did. I went to school, got okay grades, but got a job in corporate America and was doing the 401k, had the house with the mortgage and all that kind of stuff. And I was told, you're doing everything right. You have the American dream, as they call it. And I felt like it was more like the American nightmare, to be honest, because I was not really happy. I was broke. I didn't really know why I was doing this job, all that kind of stuff. And one day I was at a doctor's office, and this is kind of a weird thing, but I was at the doctor's office, and I had there. Remember how they used to have those tables with all the magazines? Now everybody's just on their cell phones, but back then they had the magazines, and there's a financial one, and I picked it up and I opened it up to some random article, and it talked about how the millionaire in the world, the millionaires, they know their net worth, but everybody else typically does not. And I realized, uh-oh, I don't know my net worth. I know I'm not a millionaire. And that was the piece of paper right there I did the math on. I was worth a negative amount of money. That kind of scared me. I was like, what the F is going on? I've been working for, over 10 years in corporate America and I have a negative net worth. Yeah, it kind of freaked me out. But we all kind of have that epiphany moment. And mine was my grandfather. My grandfather was my idol, pillar of the community kind of guy. He's a teacher at the local high school and a coach. And he worked up until his late 60s to be able to retire. And he had this big dream of traveling around and doing a bunch of stuff with his wife, my grandmother. And he did that. He retired, bought a motorhome, traveled for about a year and a half, and then he got really sick. He actually got Parkinson's, leukemia, and some other things, and dialysis, all this kind of stuff. And right before he passed away, he pulled me aside and told me, live your life now, don't wait. Because he waited, he felt like. And it made a big impact. And so eventually, what did I do? I left my job, and I discovered what we're going to be talking about on this presentation. And this is one of my businesses because we can all say they were successful, but this is one of my businesses. Back in 2021, it was an Inc. 5000 business, did over 2 million in revenue, very successful business. But the driver of that business was the strategy we're going to be talking about today. And so this has really led me to having a different life than I expected. So I've done a lot of stuff. I've traveled. I love to travel. So I like experiences. That's my big thing with my family. So, and I love cars as well, by the way, classic cars, not new ones, but classic ones. And it's led me to speaking about this concept to other people like I'm doing right now. I love to teach this concept. This is me actually speaking at a very high level mastermind. There were, people there that are very successful, even with some billionaires in the room, and teaching this concept to other people. So that's what I love to do. It's just kind of something I'm very passionate about. So that's just a quick, side note about who I am and stuff like that. Now, I want you to understand one thing about this presentation. It's something, it's not a new concept. It's been around for a long time. I'm talking, hundreds of years. And who else talks about this? Well, you guys heard of Robert Kiyosaki, so Rich Dad Poor Dad. So he talks about it in his book Second Chance, and one of his advisors was my mentor for this concept, by the way. So he talks about it in that book. It's a great book, by the way. Tony Robbins, in his book Money Master the Game, talks about this concept as well. And then, of course, Nelson Nash, his book called Becoming Your Own Banker is the one book that really is the foundation. If you want to understand more about this, that's a foundational book right there to go check out. So I'd recommend these books. And then Mapping Out the Millionaire Mystery by Brent Kessler and Chris Naugle, two of my friends and mentors. That's a great book right there. And then, of course, the Private Money Guide that Chris wrote about how to do private lending with infinite banking, by the way. Another thing I want to share with you is who has used this concept, the infinite banking concept, through history. Well, Jim Harbaugh, he was one of the top paid college football coaches, and they paid him through this strategy. And if you ever want to know how they did that and why they did it, I'll explain it to you on a private call because it's a little bit of an explanation, but it's pretty cool how they did it. Then this gentleman, you may remember him, maybe not sure. Joe Biden, ring a bell? But former president, he has 6 of these things in place. So he does this concept. Walt Disney, so it's kind of interesting. So Walt Disney, he could not get bank financing to start Disneyland. And so he ended up using his own banking strategy to start Disneyland. It's kind of weird. So we would not have Disneyland as we know it today if it was not for this concept. Ray Kroc used it to start McDonald's. So when he was growing McDonald's and expanding it for the first 8 years, he was actually funding that growth with the infinite banking concept. Pampered Chef, so she started that with one of the concepts, and then of course it's now a billion-dollar company that Warren Buffett, I believe, owns. And then lots of wealthy families, and I've studied wealthy families. I've talked to them personally. It's pretty impressive how they use this. But Morgans, JPs, the Vanderbilts, the Rockefellers, and now you too, by the way. What I want you to understand though is what will infinite banking do for you? This is pretty powerful. So here's some things that it can do for you. So one, it creates guaranteed tax-free, by the way, generational wealth day one, not 30 years down the road. Day one, it's built. It allows you to grow your money uninterrupted, compounded for the rest of your life with guarantees. Now, I like the word guaranteed, by the way, but uninterrupted compounding is one of the most powerful things that exists. It does not really exist outside of infinite banking that I've really found. But you can kind of make it work, but this is the best way to do that. And that just means that it'll grow no matter what you do with it. You use it or don't use it, it still grows the same. So that's pretty impressive. It takes control of your money away from the big banks and away from Wall Street, away from corporate America, and puts that control into your hands. Remember at the very beginning, I have to ask the question about control. That's why we love this. It does take that control away from them and puts it into your hands. It protects your money from lawsuits, from bankruptcy, divorce, court orders, creditors in most states. And then it allows you to be the bank for things that you may normally use a bank for. Think of real estate investing, college, cars, homes, investments, retirement even, all while having all the benefits listed above. So the very powerful thing about infinite banking is that it does not just do one or two of these things, it does all of them at the exact same time. So who wants to have all these benefits in their life? Now, this is what one thing I want to share with you is it's an analogy, and it's called the backwards bicycle. Now, this is a kind of a cool thing. So you can go Google this after the presentation. There's a video out there on it. Now, who learns quickly? Well, kids do. Like they learn how to ride a bike. And guess what? When you learn how to ride a bike, it's like 10 years later, you can still ride that bike. Even if you haven't ridden one in a long time, you can typically hop back on and figure it out, right? But the backwards bicycle is very different. And so in the video, this guy hops on the bike, but when the backwards bicycle is, you turn the handlebars to the left, the tire goes to the right. And the guy trying to do this, he can't ride the bike. He falls over, all that kind of stuff, because he's been programmed or learned how to ride a regular bicycle. Now, eventually, he learns how to ride the backwards bicycle, and it's pretty funny. And it's the opposite of what you think. But guess what happens? When he hops on a regular bicycle, he can no longer ride that one because he's reprogrammed the way that he rides a bike. It's the same around money. So this is kind of an analogy. So we've learned how money works a certain way for most of our lives. Right now, we're going to challenge that and change that way of thinking about it, just like the backwards bicycle. And once you learn a new way about money, it's very hard to go back to the old way of money. Now, we're going to be talking about one thing first. Where does your money go first? That's the one big thing, is where your money goes first. We're going to be looking at that here in a moment. Jody, great question. How much does it cost upfront to set one of these up? There is no cost. So there is no like upfront fee that you have to pay to go through this and stuff. It's just funding your banking policy. And so I'll get into that here in just a moment, but great question. But yeah, there is no cost or upfront fees. If someone tells you there is, or they're going to charge you an upfront fee to set this up, my opinion, run away. Yeah, there shouldn't be any kind of fee like that. All right, so here's what I want you to understand. So why aren't more people successful? This is called the mysteries of money. So wealth killers. So what kills wealth? Taxes? I don't mind paying taxes, but I'm a lot happier paying a lot less, to be honest, right? Inflation, the hidden tax, they call that one right there. Inflating of the money supply. Volatility, okay? Volatility, the markets go up and down, can really kill wealth. Interest. So the average family before COVID, by the way, paid a bit over $18,000 a year in just interest alone. That's the average. Some people pay a lot more, some pay less, but the average is 18,000 that goes out. You cannot use that money ever again. Mindset, following the status quo, fear or FOMO, fear of missing out, life in general, and then what we're taught. These are all things that can kill wealth. Now, a couple other things I want to make sure that we're clear on before we get into the meat and potatoes of this. So what is the definition of money? It's just a means of exchange. It could be dollar bills, it could be yen, it could be seashells. It's just a means of exchange. That's all it really is. Also, what company uses compound interest? Most people think that banks do. Well, they charge you interest, but they don't really use compound interest as we're going to be talking about it today. There's really not a business in the world that uses compound interest. Are your dollars worth more today or in the future? Think about this. If 20 years ago you walk into a candy store with a dollar bill, how much candy can you get? Quite a bit. Today, maybe half a candy bar if you're lucky for a dollar bill. So your money is worth more today than it is in the future. So keep that in mind. Will taxes go up or down? Typically they go up. Very rarely do taxes ever go down, right? Unless you make less money. Then all of a sudden you're not paying as much in taxes, but they typically go up, not down. Okay. Would you wait to eat bread or drink milk? Or would you wait to drive a car? Like you go buy a Honda Accord. Would you wait 5 years to start driving that car? Of course not. You wouldn't buy bread or buy milk, go put it in the freezer, and then maybe it multiplies, into two, loaves of bread 5 years down the road, and then you're going to eat it? No, it's going to be gross. It's going to be all burned and all kind of and nasty. But here's the thing. What do you do with money? So With a retirement account, like a 401k, you put money into that and you don't use it until down the road. So we do things with money, put it somewhere, and then expect to use it down the road, but we don't do that with things that money buys. Food, a car, you don't wait to use those things. So what we're talking about with this concept is you want to use it today and down the road. The best of both worlds. That's a big part of infinite banking. So let's kind of start talking about how banks work. So we can start to get our mindset right around this. So let's look at an example of how we use a bank to make a purchase. So let's look at a car because most of us have purchased a car, cash, a loan, however, right? So let's look at a $25,000 car. Now let's say that you actually have $25,000 in the bank. And so you're going to go take that cash out of the bank to buy the car. Make sense? But what if this happens? What if the banker says, hey, wait a second, Brian, before you take the money out, how about this? How about you leave your money in the bank and I give you 4% on your money that's in the bank and I give you a loan for $25,000 with your cash as the collateral. So what's going to happen in this scenario? You leave the cash in the bank earning 4% and you get a loan for $25,000 to go buy the car. And let's say it's at 6%. So you have a loan at 6%, but you're earning 4% on the same money, same amount of money. Now the loan of 6%, let's say it's a 5-year note. That's pretty typical. 500 per month, 60 months. Monthly payment is 483. So what does that look like when we look, down the road? So your future payments back to the bank are going to equal $28,999. Now here's the thing. You say, well, wait a second. So I'm losing money, but get this. The future value of your money earning 4% in the bank is $30,525, which means you've made $1,526 by taking a loan because you're earning the same you're earning 4% on the same amount of money. So in this scenario, it actually makes sense. Now, the one thing people will say at this point in this example is, well, wait a second, Brian, but I'm making a payment. If I use cash, I'm not making a payment. Well, if you paid it, so how did you get the $25,000 in cash in the first place? Oh, I saved it up over time. Every month I put a little bit into my savings account. Okay, so if you use the cash to buy the car, would you want to save the savings account back up again? Would you put money back into it to get it to grow it again? Yes. This is no different then. The cash flow is exactly the same in that scenario, but you actually made money earning 4% while paying 6%. Now, why is that? Well, the 4% is compounding on top of itself. It's growing, while the loan, you're paying 6% on a decreasing balance. So that's the math, and it's just math, by the way. So you got to understand that this is what we're talking about right here. Okay, so here's the 3 things we're going to be sharing here in this presentation. So one is the machine. What is the machine that makes infinite banking function? The next thing is the marathon. How do you build wealth with infinite banking? Because building wealth is typically, it's not a sprint, it's a marathon. And then lastly, how do you build wealth like a millionaire? And that's generationally as well. So we're going to talk about that as well. So those are the first 3 things. Let's get into the machine. So what is the machine that makes infinite banking function? Think of infinite banking once again as a car. A car has tires, it has seat belts, it has a radio, maybe, windshields, all this kind of stuff. But if that car, which is infinite banking concept, doesn't have an engine, can it function? No, it can't. It can't go down the road. It has to have an engine. So what is that engine? That engine is nothing more than a specially designed, by the way, dividend paying, permanent whole life insurance policy from a mutual insurance company that pays dividends, of course, as we can see right there. So that is the engine that makes infinite banking function. So we're going to talk about the engine, but we're going to be talking about the car a lot as well, because the engine is just that, but the car is what you really want to drive. Make sense? And that's infinite banking concept. Hopefully that makes sense. Now you might be saying, okay, why life insurance? And who else does this? So I want to share with you one thing here. So this is called BOLI. So it's called bank-owned life insurance. So what is that? Well, traditional banks, like all the banks that you know and you probably use, Chase, Wells Fargo, they all own more whole life insurance than they do all of their real estate and buildings combined. In fact, from 2016 to today, they've more than quadrupled their holdings of whole life insurance. When we talk about infinite banking, coming back to this concept right here, in this example, what we're talking about is being the bank and also the borrower. So we're actually on both sides of the transaction. Does that make sense? Not just the borrower, but we're also the bank as well. So we benefit by being the bank and also the one that can borrow from our own bank. That's what's going on. So why we want to be the bank? Let's understand how banks use our money. So this is kind of crazy how they do this. This is called fractional reserve banking, by the way, and it's kind of part of what banks do, which it should be illegal, but it's not. So here's what happens. So let's say you go and you deposit $100,000 earning at a bank, and they're going to pay you 4%. Now for the bank, that's a liability because they owe you $100,000 and 4% on that money. Okay. But what does the bank do? Well, when you give your money to the bank, they actually now own your money. It's their money, by the way. It's just a deposit. You have a deposit slip. So what's the bank do? They don't sit on it. They put money into motion. That's how they make money. So what do? Well, maybe they lend it out on a home loan at 7%. But what does the person that sold the home do with the money? Well, it probably goes right back into a bank again. But what's the bank do? They put it right back into motion again, maybe on a car loan at 8%. What's the car company do? Puts it right back into a bank again. What's the bank do? Put it right back out again. Maybe it's a home remodel, 9%. What's the contractor do? Back into the bank. Bank puts it right back into motion, maybe a debt consolidation loan, right back into the bank again through the credit card companies. So their money is in motion. So what happens is when you put your money into a bank, they actually make 500% or more off of your money than they're paying you. And it's just math, by the way. And this is not something we just made up. You can go to bauerfinancial.com and look this up. Banks make between 400 to 1,300% on the money that you leave there. And Anthony said it right there, using the same money over and over and over again. And then banks also do something on top of this called fractional reserve banking, which is where they can lend out 9 times what they take in, which is one of the biggest causes of inflation. So banks are very disastrous when it comes to money. But why do banks exist though? So think about that for a second. A lot of people will say, well, they exist to, for you to put your money into them. They exist to lend money. They exist to make profit. They're a for-profit organization, so that's why they truly exist. So they do it by putting your money to work. That's a big way they do it, and then lending back out to you. All right, now to understand why becoming our bank makes sense, let's look at the annual pattern of the typical household, the average pattern of spending in the average American household, by the way. So for every dollar that comes into your hands or into your bank account, it goes somewhere. Okay, so where does it go? Now these are average numbers. So on average, 20 cents or 20% of every dollar you bring in goes to automobiles, payments, upkeep, that kind of stuff. 30 cents goes to housing. So think of rent, mortgage, things like that. 40 cents goes to everything else. Think of food, clothing, entertainment, all that kind of stuff. So that's 90 cents right there. That's 90 cents of every dollar goes right back out to somebody else. What's left? About 10%. So the average person saves hopefully around 10%, oftentimes a lot less, but around 10%. Now, if you go to a traditional like financial planner, they're typically going to talk to you about that 10%. Now, on this presentation, we're not going to talk about that 10%. We're going to talk about the other 90% and what's happened inside there because there's interest. In that 90% that goes out the door, there's interest involved. So let's look at what that is. So let's start with 10% savings. It's assuming the average household saves 10%. Now, when you look at automobiles, 20 cents goes to automobiles. Around 5 cents of that 20 cents is interest, by the way. Let's recapture that back. So this is called recapturing. So what if we recaptured that interest back into our savings instead of giving it to a bank? Then we come to housing. Now, housing is 30 cents, but on average, around 25 cents of the 30 cents is interest. That's called an amortized loan, by the way. And by the way, if you're renting, you're actually it's 100% loss because you're not getting anything out of it. There's no interest. So what if we recaptured some of that interest, put it right back into our own pocket instead of the bank's pocket? And then, of course, there's everything else. That's the food, clothing, all that kind of stuff. That's 40 cents. Around 5 cents of that, credit cards, by the way, is mainly where that goes, is interest. So let's capture that back. So there you go. So you can capture, if you recapture interest back into your hands by being the bank, you benefit. Now let's look at some examples of how you can do this. So what I want to show you right now is how to get all of the money back that you'll ever spend for every car that you ever buy, drive, and own. So you're going to get all that money back. Now, obviously, this is a classic car. Most people aren't going to buy that with financing, but I've owned Mustangs before. That's not one I've ever owned. I'd love to own an Eleanor, but I don't have a couple $100,000. So there you go. So let's look at the machine. Let's look under the hood of how this thing functions. So what you're going to see here on the screen on the right-hand side is, we call it kind of a tabular detail, but this is a basic like illustration. So you're going to see a few things on here, and I'm going to explain what these things are. Now, As you guys know, or if you guys have known me before, but can already tell, I do tend to talk pretty fast, so I'm going to try to slow it down here a little bit. I just get so excited about this stuff, so sorry. So let's talk about the premium deposits. So there are premiums. So think of like car insurance, health insurance, there's premiums. With infinite banking, because it is a life insurance policy, there are premiums. We call them premium deposits because you get a benefit. You can use those deposits like a bank. So you're going to see that right over here, deposits right there. The next thing we're going to talk about is age. So you're going to see age over here. Some people say, well, does age matter? It does matter, but not always. So someone says, oh, am I too old to do infinite banking? On yourself, maybe, but you can do infinite banking on other people in your life, by the way. So there are ways to do it, even if you're maybe, 75 or 80 years old, there's other ways to do it. So, but I have clients all the way up into their 70s, so it's usually not an issue. And then the earliest you can do a policy, by the way, is I think it's a couple weeks old. You have to have a social security number first when you're born, and then you can get a policy. Death benefit. You're going to see death benefit on these things. Now, we do not focus on the death benefit. It is a benefit, but it's not the focus of infinite banking, but I will address that a little bit. All right. So let's look at how this thing works. So in this example, and this is a very, very conservative example of how infinite banking can work, this individual is going to put in $10,000 per year. That's their numbers. Does not have to be yours. Yours are your numbers. We go through those on a one-on-one call, by the way, on what your numbers can be. Can be higher, can be lower. It's up to you. And you can do that monthly, annually. It's up to you. All right. So this person is going to put in $10,000 into their policy, deposit that in for 7 years. When you have infinite banking, when you fund the policy, it builds what is called cash value. Okay, right there, you'll see cash value. That is what you can borrow out. And this, once again, this is very, very conservative. The ones that we typically do are going to have a lot more, but we want to make sure that we show you a conservative example because even then, it's still extremely powerful. Now, as the cash value builds, this person at the end of year 3, by the way, the end of the year, has over 25,000 of cash value. So they're going to go and borrow against that cash value. That's called a policy loan. So they're going to borrow out of their policy. It's a guaranteed loan. There's no credit check. There's no qualifications. It's a guaranteed loan. They can choose how and when to pay that loan back. It's up to that person. It's up to you, by the way. There is no required payment. Now, we recommend you pay it back. Be a responsible banker. Okay. And yes, loans aren't taxable because they're not considered income. So this person says, hey, I'm going to pay it back. Same as that previous example of the car at $500 per month or $6,000 per year. They're going to pay that back over 5 years. So now at the end of year 7, what are the numbers? So they have put in $70,000 as a premium deposit, and they have put in $30,000 as a loan repayment. So that's $100,000. But also keep in mind, they did take a loan out of cash to buy the car. So they actually got $25,000 out of the policy as well. So the real math is they put in $75,000. At the end of year 7, they have access still to $67,000. That's 91 cents of what they put into the policy they have captured. Now, here's where it gets really powerful. Now, by the way, typically that's going to be it'd be like 100 and something percent in the way that we would build this, but once again, being very conservative. Now, in years 8 through 12, what happens? This is very cool. So in years 8 through 12, they choose to put in no more deposits. They can choose to do that if they want to. No more money goes into the policy. But here's the thing. Because this is a dividend paying policy, it keeps on growing even though they're not funding it anymore. So as you can see over here, it keeps on growing. It's going up and up and up. Now, at year 8 or the end of year 8, this person says, hey, you know what? My daughter just turned 16. Mine's about to turn 15. So great example. I'm going to go buy her a car, $25,000. Again, same thing happens. They make the same payments right back to their policy. But what's the math now? So in years 8 through 12, they put in $30,000 as a loan repayment, but they took out $25,000, which means they put in $5,000. But between years 7 and years 12, the policy grew by $23,592. So it kept on growing. So here's the math. How much has this person put into this policy in these 12 years? $75,000 plus 5 is $80,000, and yet it's worth $91,000, more than what they put into it, and they own 2 cars outright. So they own their cars outright, and they have made money. If they had done a loan from like a bank and done the same kind of example, they'd be out over $50,000, and they'd own their cars. But they would have been out over 55,000, or probably 55 and with the interest. They'd be out quite a bit of money. So this is how infinite banking can work. quick example. And by the way, that doesn't make any sense. I can map it out for you on a one-on-one call, but that's the power of infinite banking in one simple example. All right, so there's three rules with infinite banking that we tend to follow. So one is pay yourself first. So where your money goes first is very important. Pay yourself back and recycle and recapture. So one, pay yourself first. We've been trained all through our lives to pay somebody else first. Bills, credit cards, the banks, all that kind of stuff. Okay. Paying yourself first means controlling that money first. The second rule is pay yourself with interest. So if you're going to be the bank, be a responsible banker, pay it back with interest. And the third one is recycle and recapture your money. What does that mean? It means it's better to pay yourself than a bank. Absolutely. So if you're going to go do something like buy a car, pay off debt, invest, use the policy, use the infinite banking concept to recycle and recapture as much of that money as possible. Now, this works for a car. That's just a simple example. You can invest the money and do other things that create cash flow and build wealth even faster, by the way. But what is another common thing that steals wealth, by the way? Debts. Debt is one of the biggest thieves of wealth that exists. So this is an example. This is a chiropractor, by the way. It's just his wife. But he says his wife. But yeah, so debt is something that steals a lot of wealth. Now, people are absolutely blown away by what infinite banking can do when it comes to debt. And there's even ways to even accelerate beyond what I'm going to show you here. But this is a simple example. So this is a 45-year-old chiropractor, 9 third-party debts. Okay. Total debts are around $478,000. And the monthly payments this doctor is paying out is $5,777 per month. So that's a lot of money going out the door, right? A lot of money going out the door. So in this example, this doctor, it would take him 19 years to pay off that debt. That's a long time, a long time. Here's what's going to happen. So this doctor is going to deposit into his banking policy $25,000 per year. He's going to do a one-time premium annually at the beginning of each year. You can do it monthly, it doesn't really matter. He's just doing it for as an annual premium. Now, the question I get a lot is, well, where did he come up with the $25,000? Why isn't he putting that $25,000 into the debts? Good question. So this doctor had 401ks and some other retirement strategies that he was putting money into. And he didn't quite like them, but he didn't really have any other options until he came across infinite banking. And he said, hey, wait a second. I'm going to stop putting some of the money into this concept. Maybe it was a 401k. I'm going to put it into infinite banking instead. So he just moved money from one bucket to another bucket. That makes sense. He didn't like just, take $25,000 from his income per se, and he took it from another bucket that he was putting income into and just diverted it over here. Now, when he does that deposit, he has within 30 days access to around $14,863. Now, that's a very conservative number. The way that I would typically build some of these policies, it'd probably be more closer to like $20,000, by the way. But once again, we're being very conservative with the example. That's what's happening. This doctor puts in 25, has access within 30 days to around 14,000 and change, typically more, but once again, very conservative. So what does he do now? Well, he goes to the policy, his own banking system. It's a guaranteed loan. He borrows that loan back out of 14,000. And then he uses that $14,000 and he pays off the Discover card, the Lowe's, and part of Nordstrom's. His debt drops and his monthly payments drop by $448 per month. But what does he do? Well, we don't just spend that $448. We recapture that. Remember rule number three, recycle and recapture. So he recaptures the 448 into his banking policy or into his checking account, wherever he wants to put it. Now, year 2, another 25 goes in. Cash value now goes up by 16,000 and change. The payments of 448 back to himself, so he's recapturing that money, equals $5,000. So his total cash available is $21,945. So what's he do? Takes that money out, goes and pays off Nordstrom's, Wells Fargo, the private loan, and part of the BMW. Motorcycle, maybe a car, who knows, right? And so now his debts have dropped and his monthly payment has dropped now by $1,917. Okay. So year 3, what happens? Probably starting to get the picture here. Year 3, another 25 goes in, cash value jumps up by $25,000 in that case. The payments back to himself of $1,917 equals $23,004. So now he has total cash available to access is $48,545. So what's he do? Same thing, borrows it back out, And now he wipes out BMW, wipes out the West Marine, probably a nice boat, by the way, and part of the condo, by the way. His payments have now dropped by $3,677. I want to pause here for a second because the marathon concept here, the marathon. So let's look at this. What has happened? So he has put in $75,000 into his policy so far, but he's taken out how much? Right around $55,000 and change. How much is left in the policy? So remember, these are specially designed policies. They earn dividends. That's the compounding. So how much is left in the policy earning dividends? Is it $20,000 because he's taken 55 out? No, it's the full $75,000. You're still earning dividends on the policy even though you've borrowed against it. So the dividends do not change. It keeps on growing even though you're using the money somewhere else. One of the more powerful things of infinite banking right there. It's pretty cool how that works. So let's go to year 4 now. Same thing happens. 25 goes in, cash value jumps up by $26,000 and change. The payments of $3,677 back to himself equals $44,000 and change. Total cash is now $70,439. Same thing happens again. Now he wipes out a huge chunk of the condo and his payments or the total debt drops. Now, the thing to remember here is in year 4, the payments don't change. So his monthly payments don't change because the condo and the house, they're amortized loans or mortgages, by the way. And so the payments don't change, even though the balance went down. All right, just keep that in mind. So now year 5. Now, if you'll notice between year 4 and year 5, you'll notice that the amounts drop though, because he's still making payments of $2,100 on the condo and the house during the 12 months. So keep that in mind. So year 5, same thing happens again. 25 goes into the policy, cash value goes up by 27,000 and change. Payments back to himself of the 3,677 are 44,000 and change. Total cash is $71,225. He borrows it back out, wipes out the condo and a huge chunk of the house. Now what happens in year 6? Now in year 6, by the way, yeah, his monthly payments dropped by $4,556 now. So he is really starting to recapture a lot of money, So what happens in year 6? Now in year 6, the doctor said, hey, he goes, I love this concept. I want to do more of this. So I want to take more money from this retirement bucket over here and put it into infinite banking. So what's he do? Well, he drops the first policy premium down to $10,000. You can do that, by the way. So the premiums are not for your entire life and they can never go up, but they can go down. So he drops his first policy down to $10,000 per year. Cash value on it still grows. Okay. It grew by 13,000 and change. On the second policy, same thing. 25 goes in, access to 14,863. And then what happens is the payments back to himself equal $54,000 and change. So the total cash that he has access to is $82,000. Now, this is the beginning of year 6, by the way, not the end, but the beginning of year 6. So what's he do? Well, he borrows out enough to pay off the house, wipes the house payment off. His monthly payments are now zero going out to the debt companies. So he is now debt free from that. But what's he still have? He has the infinite banking policy loan. Now, if you notice what I was doing here, there was no payments back to the policy loans because you don't have to make payments. So in this example, the policy interest is low while the other interest rates are very high. So we don't pay back the policy loan. You can pay the interest if you want, but he's not paying it back. So year 6 and part of year 7, he takes the monthly payment of $5,777 and he pays back the policy loan. Toward the end of year 7, his policy loan is now zero. He has 6 figures of cash value of wealth and no debt, and he's earning dividends. Now what's he do? Well, that's the third thing we talk about, building wealth. Now he takes this policy, all this cash value that's growing uninterrupted, and he puts it to work in investments, cash flowing assets, real estate, whatever he wants. Maybe buys a car, who knows, right? But now he's going to go make that money work in a second place. Now, Anthony made a good point here. What we don't talk about here is all the interest that he saved, because 19 years versus 7 years. He just saved like 12 years of time right there. And now what's he going to do with that? Once he pays off the policy loan, what's he going to do with the 5,777? Maybe it's a third policy. Rolls that money through that and then puts it to work again. So that's kind of the third thing. Now, if you're saying, well, Brian, that sounds cool, but man, that's very complicated. I agree, right? I'd agree. So we have tools and software that will map all this out for you, and software that maps out other ways to use infinite banking, loans, forecasts, all that kind of stuff for you. This is called the Debt Blaster, but it maps out how you do what I just showed you, whether it's monthly or annually. We'll show you how to do it. And then you just have a plan, you follow it, there you go. And this is the stuff that we all use in our own lives too, by the way. So there you go. And we also have what is called the implementation team or mapping team that actually will help you use the policy. So we're actually help with you before, during, and after you have the policy. We're there the entire time, and we actually provide ongoing support. After the fact, there's no cost, no fees, nothing like that. So we help you use the policy. All right, so let's talk about the third thing, the millionaire. How do we build wealth with infinite banking? So what if I have no debt? Or what if I've used infinite banking to pay off the debt? Or what if I don't need that new car? Something like that. Can I still benefit from my privatized banking system? The absolute answer is yes, because this is where the fun begins. This is where we start building wealth and creating that legacy. So here's some things that a lot of our clients and ourselves have personally used infinite banking for. So real estate investing. So I've done flips, buy and holds, subject to owner financing, all that kind of stuff. Commercial properties. So apartments, mobile homes. I actually have one of my first students I taught many years ago. He owns I think he has like a 4 or 5-plex now through infinite banking. Started off with a single family and then just kept growing them and sold them all, bought multi-units. Private funds, passive real estate, so lending out to other investors, that kind of stuff. Business owners, by the way, use it for their business as a revolving line of credit. Oh, that's a great point right there. So the cash value component of infinite banking of these policies is like a revolving line of credit. Money goes in, money comes out, back and forth, except you're the one in control of it. So that's why a lot of business owners love this concept. They're building a retirement thing at the same time as using the policy to build their business. Stocks and options traders. And I'm going to go through some examples, by the way. You'll see some actual policies in my presentation, so keep that in mind. Startups, I've had people start up their own business with this. Equipment flipping, by the way, all sorts of things. So I want to show you now an example of infinite banking for private lending, how it works. So this is what's called a tabular detail. When you guys go through the process of going through the applications, you'll see one of these for your own numbers. Now you're going to see two sections: net cash value over here and net cash value on the right-hand side. The right-hand side is with dividends. The left-hand side is the guaranteed return. Now, these mutual companies, they've never paid the guaranteed number. They've always paid the non-guaranteed dividend side. Why is that? Because they've never lost money. 188 years, that's the age of some of these companies, they've never once lost money. They've always been profitable. There's never been a default. These companies have never gone bankrupt. It's never happened. So if you understand what I just said, when you look at banks go under. Great Depression, 9,000 banks went under. Half of all banks, by the way, went under during the Great Depression. Mutual insurance companies paid dividends and were profitable all through the Great Depression and all through history. We always look at the non-guaranteed side because they've always paid them. In this example, you'll see, okay, here's the contract premiums going in, the deposits they're putting into this policy. Now you might be saying, well, Brian, why is this one $150,000 in year one and then it's $50,000 a year the following years? That's because they did something called a dump in or a drop in. So I'm going to explain that a little bit in this one, and then I'll explain it a bit more down the road. So when you do these policies, you have the option to put in what's called a dump in at the beginning. Usually you can do it more than once, but typically at the beginning. And when you do that, you have access to 90% of that money within 30 days. So this person put in a $100,000 dump in, had access to 90% of that within 30 days. At the end of the first year, they have access to $132,000. But you'll see this thing just keeps growing and growing. You'll see dividends over here. Let's go look down the road. So the numbers are very impressive right off the bat. But let's look at year 8. I want to show you the power of this thing down the road. So year 8. In year 8, the cash value went up. This is the end of year numbers, by the way. These are end of year numbers. So end of year 8, the cash value had increased by $66,722. So that's how much it grew by. But how much did this person put in? They only put in $48,594, but it grew by 66. So what is the math on this example? That's a 37% cash on cash return. So who here wants to have a 37% cash on cash return on their money? I'm not raising my arm, right? Give me a 1 or yes in that chat box. I mean, that's a pretty good return right there on your money. This person, as an example, goes and lends out that money. Now they could lend out $66,000 or they could lend out $531,000. Okay, because that's how much cash value is in this policy. Keep this in mind though, they've only put in $498,000, but the cash value is $531,000. That's just inside the policy. That's not including what they're doing outside of the policy as well. So this person now private lends the money. Let's say they lend it out at 12%, typical hard money rates. So 12%, but they're earning 37% already. Let's say the interest rate on the loan they're paying back to the insurance company is 5%. That's a 44% cash on cash return right now. So that's what they're doing. At the exact same time, they have a $1.371 million death benefit. They've only put in 500, but they've been able to use this cash value in all of the previous years as well. This doesn't even show the percent they're earning outside of the policy. Maybe they paid off debt. Maybe they invested the money. Maybe they lent it out. So they made money outside the policy as well. So here's the thing though. This person was already investing this money. They already put it into investments. All they did was, hey, rather than putting it into the investment first, I'm going to put it through the policy first. We did nothing for this client other than where the money went first. Now it goes through the policy first and then back out to the investments. That's the only difference. The question is, and this person, this is why they did this, because they were already private lending at 12%. But when they saw what they can do down the road, they can be making 44%. And the longer the policy is in place, the better and better those numbers will get. And I'll show you an example of that here in a moment. So here's an example of how uninterrupted compounding works. Because in that example right here, in this example, if they borrow out the money, nothing on this page changes. They're still earning dividends. The cash value is still growing, even though they borrow the money out. It's still growing. So that's one thing to keep in mind right there. Now, in this example right here, this is just an example of someone who put in a $50,000 lump sum dump and around $6,000 per year. But look at the numbers as the policy ages. 21% cash on cash, 26 at year 5, 54% at year 10, 115% at year 15, 191% at year 20. Look at the access to capital. 121%, 126, 154, at year 15 is 215%. Like that's incredible. So that's how uninterrupted compounding can work, because no matter what you do with the policy, it's still growing. So how do you do the millionaire method? The question to that one is, how do you eat an elephant? It's one bite at a time. And the other example I like to give is the man at the top of the mountain didn't just fall there. When you think about the person that's out at the top, like they've had that success, they're at that place that everybody wants to be, the top of the mountain. They didn't just fall there, right? They chose to take that first step to climb the mountain. Unfortunately, most people, in my opinion, don't choose to climb the mountain. They choose to go around the mountain, wanting to be at the top. And by the way, that was me back in the day. That was me. Infinite banking is about taking that first step and climbing that mountain. It's about eating the elephant one bite at a time, as an example. So I want to kind of share that, because a lot of people want that easy button, want to be a millionaire next week. Not really how it works. Is it possible to owe no man nothing? Possibly, yes. So infinite banking is a way to kind of start that process. So the machine, infinite banking, it works for debt and expenses, vacations, homes, taxes, everything else as well, by the way. So I have a lot of people that use infinite banking to pay their taxes or home insurance. That's kind of one thing I do. So I take a certain amount out of my income, my cash flow, and I pay back the policy loan, but I have the policy loan pay those things. So it's just a cycle that I do. Now, remember the doctor? So this is kind of a quick example of, obviously generationally, how can infinite banking be very powerful? So let's say that like you open up a policy on like the next generation. So Frank said about his grandkids or granddaughters. What if you open up a policy on them, and then when they were, in their 40s or whatever, they go buy a home, but they use infinite banking instead of using a bank. So I'll use the doctor as an example. So if that doctor had paid back the home and the condo as scheduled to the banks, right? There's the payments. Let's just assume that they're traditional mortgages. He would have paid out of pocket $493,000. Now let's assume that he could have used his own banking system to buy the homes instead of using a bank. Let's just say he had that kind of cash value in there. Okay. Let's say that it was a 4%. What would his policy have grown to? If he had paid for the homes with a policy and then paid his bank back, he would have paid himself back, right? But the policy would have grown cash value wise during those years by $750,000. Now, granted, yes, in this example, it would have had to been funded first, but just understanding generationally how powerful this is. So like if your grandkids could do this, they would have either paid $493, or if you set this up for them, they would have made $750,000. It's a huge swing, by the way. Now, you can do this for investing in real estate, that kind of stuff. These numbers are very cool when you get into investments. And we have software, by the way, that does map that out. Just want to make sure you are aware of that. So this is actually called a gain projector. Real estate investors use this to map out the best way to maximize the policy when investing it into things like a rental property or a cash flowing asset. So we have ways to map this out. Now that you know this, I believe everybody should do this because when I look at wealthy families and how they've explained to me what they've done, it's mind blowing how they do this. And so I have people and clients that learn how to do this. They're blown away. They teach their kids, their grandkids how to do this because it is so incredible. It generationally, this thing is insane. But the first thing you got to understand, what are you doing with infinite banking? You're actually getting your money to work for you. And I love this little example, this picture here, because so many people are on the bottom right there, working hard for their money, but we're not actually getting our money working for us. And so that's sort of the flip that we want to make when it comes to infinite banking is get our money working for us. Okay, so some other things I want to share with you real quick. Death benefit. We didn't talk about that. I'm going to share a little bit about what I just talked about around death benefits. The loans. So the loans on these policies, and I'm going to explain to you how they work. They don't have to be repaid. The policy grows tax-free. So it's unlike, tax deferred things like a 401k, IRA. This grows tax-free because you never really permanently take the money out, by the way. The policies that are exempt from judgments, liens, and creditors in most states, by the way, it's state specific. And if you guys have questions on what states, I can share that with you. You can have tax-free income in retirement. So how do you do that? Well, the policy loans, I just said, don't have to be repaid. So you build this policy up over your lifetime, right? Your working years, essentially. You use it for investing, for building more assets. And then in retirement, if you want, you can borrow against it, not pay the loans back because they don't have to be repaid. They come out of the death benefit, by the way. And that's tax-free income, by the way. We have people that are doing that. All right, let's kind of talk really quickly about the generational wealth angle of infinite banking. In this example, this is a 42-year-old female, so keep that in mind. It's the way these are built are specific to every person. So this person decided, this is a real person, by the way, that my client of mine. They're putting in $20,000 per year for the first 5 years. Then they're going to drop the premium down, optional thing, by the way, to around $3,200 after that. It's an optional thing. But here's what I want you to note over here on the right-hand side, the death benefit. In year one, $20,000 goes in. At the end of the year, the death benefit is $325,000. Do the math on that. That's a many, many multiples times what she put in. In year 5, she has put in $100,000. The death benefit is $483,000, almost 5 times what she put into it. Now, God forbid something happens to this person. We don't want that, but if something does happen early on in the person's life, their money is going to create that much wealth for that next generation. Now, also, look right here. This is how much she has put in year 5. She has access to $99,000 right there. You can see that right there. But look at this. In year 6, she puts in $3,000, but the policy grew by $6,752 right there. So see how it's climbing? So that's how this thing does generational wealth. And the longer this policy is in place, by the way, the more and more that death benefit is going to grow. So the death benefits on infinite banking policies, they're not a flat number. They go up over time. So they increase. So keep that in mind. All right, the next thing I'm going to share with you is how the policy loans work. Yeah, so the policy loans, how do they work? So policy loans are guaranteed. Guaranteed. All right. There's no credit check, there's no approval. You ask and you shall receive those loans. The loans are private as well, by the way. So when you borrow against your cash value, by the way, you're borrowing from the insurance company's general fund with the cash value as essentially the collateral. Okay. And you can borrow up to that cash value. Those loans are private loans. They do not show up on your credit report. So remember the example of the doctor when he was paying off all those debts? One thing I didn't mention during that example was that what was happening is his debts were going down. They were going down over time off of his credit report. Even though he was just moving those debts into his infinite banking policy, cash value right there, they were coming off of his credit report. So a lot of people, like they might have like a lump sum of capital or cash, and they've got some debts over here, and they don't really want to just lose the cash. But they have those debts over here that are on their credit report and they can't go get a loan or something else because their debt to income is too high, that ratio. They put the cash into the policy. Now it's locked in and going to grow for the rest of their life. They borrow it out and pay off those debts. All of a sudden their credit score goes up because the debt's evaporated. Even though they just moved them into the policy loan, as far as the credit bureaus are concerned, they're not there anymore. Also, there is no required payments, right? I said that. So you're the one in control. You choose when and how to pay those loans back. So there is no required payment. Miss a payment, nothing happens. So if you go get a car, like someone said, well, Brian, if I can go get a car loan at, let's say, 4% and my policy loan is 6%, why would I use my policy? Okay, so here's my answer to that question. When you go and get a loan from a bank to get a car, who has the title? The bank does. You do not have the title. If you don't make a payment, can they take your car? Absolutely. Legally, they can take that car back. So do you truly own that car? Not really. Okay. Yep. With infinite banking, you are the bank. So who has the title? The bank does, but that's you. So you have the title. If you miss a payment, what happens? Nothing happens. So just from the control aspect, I would use my policy every day to buy the car. I would not go get a loan from a bank, even if it's a lower interest rate. The other thing to keep in mind is when you pay a loan back on a traditional loan, like a car loan, what's in the payment? Principal and interest. With the way these kind of companies work, these policy loans work, the interest is charged to the loan once a year. So either at the beginning of the loan or the end of the loan. What's that mean? It means that any payments you make during the course of 12 months, if you're doing like a monthly thing, all go to principal, which means the amount of interest you're going to incur is going to be going down because the balance is decreasing and they charge it on the daily balance. So in this example, this is a 32-year-old female putting in $10,000 as an annual premium and doing a $50,000 dump in or lump sum at the beginning. That's that $60,000. At the end of the first year, this person has access to $55,000 and change of the cash value, which, by the way, is a little over 90% they have access to at the end of the first 12 months. That's pretty powerful. And they have a $1.1 million death benefit as well. But let's look at how this thing functions down the road. So you can see here, there is a decreasing premium. Now you don't have to drop it down at year 11, but we're showing it dropping down. What's it look like? So in year 2, 10,000 goes in. At the end of the second year, her cash value, what she has access to, went up by $10,607, more than she put into the policy, by the way, in that given year. She's already cash on cash positive by year 2. The reason why, she's earning dividends on that dump in of $50,000. So higher dividends, policy is very efficient. In year 11, she puts in $3,120. Optionally, she dropped it down. $10,590 is how much the cash value went up by. Almost 4 times what she put into it. That's going to get better and better over the years, by the way. Eventually, it'll be like 5 times, then 6, then 7, 8, 10 times. It just gets ridiculous. Now, this is a quote that Warren Buffett said. I'm assuming he said this. And it says, if poor people would just do what rich people do, they wouldn't be poor anymore. I kind of changed that quote, by the way, in my mind. My mind says this: if poor people had the knowledge of the rich people, they could do things differently. Or the example is, if the poor people had the knowledge and took action on that knowledge, they wouldn't be poor anymore. Because as an example, I just gave a lot of people a lot of knowledge here today, and people are going to watch the presentation. But you've got to take action on that knowledge for it to have any impact in your life. So that's kind of my way of looking at that quote. Knowledge is power, by the way, but knowledge plus action is powerful. The other question I get quite a bit is, well, Brian, why would I want to work with you or work with the Money Multiplier, the BYOB team here? Well, one, I've been teaching infinite banking for about 9 years. I've taught it to thousands of people through presentations and webinars, and I used to have a course that taught it too, by the way. So we have an entire team, by the way. So it's not like there's 5 of us. We have a team of over 40 people that work with you on doing infinite banking. So we set it up for you. We're one of the largest, if not the largest producer of infinite banking. So the companies that we work with, by the way, some people ask me that question. So One America Financial, they're over $100 billion company. Lafayette Life, their parent company, Western and Southern, is over $100 billion. Security Mutual of New York. So we're the largest independent broker in the U.S. for One America and Lafayette. So we do a lot of these kind of policies. We do volume. I have over 100 clients in underwriting at any one time. So I have a lot of clients I work with. And then we provide ongoing support and services and guidance. That's something that a lot of other people don't do because they don't have the team to do it or the funds to do it. So we do that right there, by the way. And There's no cost to you. We don't charge you anything. There's no fees. We are paid by the insurance companies. And if you want to see how we're paid, more than happy to show you. Like we don't hide anything. We're very, very open about all that kind of stuff. Performance was just abysmal. So a couple quick slides, everybody here. So one of two things will happen to us in life. We live and we die. So are we better off with or without infinite banking in our lives? In both scenarios, we're better off with it in our lives in both scenarios, by the way. And one last thing. So when I first came across infinite banking, um, I call it the tale of two people, by the way. So I was in group one. So when I first heard about this, I was like, you know what? That sounds cool, but I'm gonna go do this, with my buddy over here. And I did. I went and did it with one of my buddies, whom I no longer talk to because, well, he should be in jail, but anyways, he's not. But guess what he sold me? A VUL. And I thought it was infinite banking, and it was abysmal. I lost over six figures of potential wealth just from that one policy. And because I didn't know what I was doing, and I chose to not go with the person that had all the information, the knowledge, the experience. I went somebody who didn't. They said they did, but they did not. Big lesson learned. So moving forward, I learned about it, by the way. I learned what had happened, and I went and found a mentor. This was one of Robert Kiyosaki's guys. And I said, hey, I'm going to go find group two, the guys that really know what they're doing, that really are trying to help people and can actually educate me on how this works. Because I'm only going to do this if I have the knowledge. I'm not going to 100% just rely upon them. And so that's what I did. And that's why we share all this information on these presentations so that you have the knowledge about this. And we have a lot more information, by the way, too. Group one, that was me right there. Go it alone, beat my head against the wall, but not in group two. So here's the next steps. Hop on a call. Let's solve your problems. Let's answer your questions and see if infinite banking is a fit for you. I'm going to be very honest here. It is not a fit for everybody. I will never say that it is because it is not a fit for everybody. Maybe 5 to 10% of the population can do this. So doing infinite banking is a privilege. It's a huge privilege to be able to do it. Because I get a lot of people that say, hey, it's too good to be true. It sounds like a scam. Well, if you're trying to go to the hottest nightclub in town that just opened, but you can't get in, is that nightclub too good to be true? No. So you have to qualify. That's kind of the big thing. And but that's where we work with you if maybe you can't qualify. Well, who else can you do a policy on? Spouse, family, business partner, grandkids, kids, lots of ways to do this. So the last slide I'd like to end this on with is this one right here. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so.